September 24, 1869. Within a matter of hours, fortunes worth millions of dollars vanished. Wall Street erupted into chaos. Banks stopped lending. Merchants panicked. Farmers feared financial ruin. The price of gold collapsed by more than 30% in a single afternoon. Some investors became millionaires overnight. Thousands of others were financially destroyed. The shocking part? The disaster wasn't caused by war. It wasn't caused by a recession. It wasn't caused by a banking collapse. It was engineered. At the center of the scheme stood two of the most ambitious financiers in America, Jay Gould and James Fisk. Their goal was breathtakingly simple: buy so much gold that they could control the entire American gold market. If successful, they believed everyone, including the U.S. government, would be forced to buy from them at whatever price they demanded. For weeks, the plan appeared unstoppable. Gold prices climbed almost every day. Speculators rushed into the market. Newspapers celebrated the boom. Even influential politicians appeared connected to the operation. Then, on a single Friday morning, the United States Treasury intervened. Within minutes, one of the greatest financial manipulations in American history collapsed. The event became known as Black Friday of 1869. It exposed the dangers of market manipulation, political corruption, and speculative bubbles, and forever changed how governments approached financial markets. To understand how two men nearly cornered America's gold supply, we first need to understand why gold controlled the nation's economy after the Civil War. The Civil War had ended only 4 years earlier. The United States was rebuilding. Railroads expanded westward. Factories multiplied. Agriculture recovered. Immigration surged. Yet beneath this rapid growth lay a fragile monetary system. During the Civil War, the federal government printed large quantities of paper currency known as greenbacks to finance military spending. Unlike gold, greenbacks were not fully backed by precious metals. As a result, gold traded separately in financial markets. Its price fluctuated daily against paper money. This unusual system made gold incredibly important. Importers needed gold to purchase foreign goods. Investors watched gold prices as a measure of confidence in the economy. Farmers preferred higher gold prices because weaker paper currency made American exports more competitive overseas. Meanwhile, the U.S. Treasury held one of the world's largest gold reserves. Whenever officials sold gold into the market, prices typically fell. That government reserve would become the greatest obstacle to Gould and Fisk's ambitious plan. Jay Gould was already one of America's most sophisticated financiers. James Fisk was his flamboyant business partner. Together, they realized something extraordinary. If they quietly bought enough gold while preventing the Treasury from selling its reserves, they might corner the market. A market corner occurs when one individual or group controls enough of a scarce asset to influence its price dramatically. As their buying continued, fewer sellers remained. Scarcity increased. Prices climbed. Other traders rushed to buy before prices rose even further. Their strategy relied on basic market mechanics. Genuine demand, supply gate, type ID, supply and demand. Rather than increasing genuine demand for gold, Gould and Fisk attempted to restrict the available supply while encouraging speculative buying. Every price increase attracted even more investors. That new demand pushed prices higher still. The cycle reinforced itself. But one institution could destroy the entire scheme: the U.S. Treasury. If Treasury officials released enough government gold into the market, supply would immediately increase, prices would collapse, and Gould's position would unravel. Preventing that outcome became their primary objective. Gold underscore. The greatest challenge wasn't buying gold. It was influencing government policy. Gould cultivated relationships with politically connected individuals, including associates linked to President Ulysses S. Grant's administration. The objective was not necessarily to control the government outright, but to persuade officials that higher gold prices would benefit American farmers by making exports more competitive abroad. Whether through persuasion, political connections, or misinformation, Gould hoped the Treasury would delay selling gold. For several weeks, it appeared to work. Government intervention never came. Meanwhile, Gould and Fisk accelerated their purchases. Other speculators noticed. Banks increased lending against gold. Newspapers reported soaring prices. Merchants began adjusting prices. Importers faced rising costs. Confidence evolved into speculation. Speculation evolved into mania. The higher gold climbed, the more convinced investors became that it could never fall. Throughout September 1869, gold prices rose almost daily. Wall Street became consumed by speculation. Brokers borrowed aggressively. Merchants delayed business decisions. Farmers anticipated higher crop prices. Importers feared rising costs. Every participant viewed the market differently. Some believed economic fundamentals justified higher prices. Others simply followed momentum. Many borrowed heavily to purchase additional gold. Leverage magnified every gain. It also magnified every future loss. The country's financial system became increasingly dependent on one commodity's rising price. As gold appreciated, imported goods became more expensive. International trade became more volatile. Business planning became increasingly difficult. Meanwhile, Gould secretly began reducing some of his exposure. Although publicly encouraging optimism, he privately recognized that government intervention remained possible. This created one of the oldest patterns in financial history. Large operators quietly prepare for the possibility of collapse, while smaller investors continue buying at record prices. History would repeat this pattern many times, from the 1929 stock market crash to the dot-com bubble and modern cryptocurrency cycles. On the morning of September 24th, everything changed. President Grant concluded that gold speculation threatened economic stability. He ordered the U.S. Treasury to sell approximately $4 million worth of government gold into the market. For the time, it was an enormous intervention. Within minutes, supply surged. Gold prices collapsed. Panic spread through Wall Street. Brokers rushed to sell. Borrowers received margin calls. Fortunes evaporated. Investors who had borrowed heavily faced immediate bankruptcy. Some businesses failed. Agricultural markets experienced severe disruption. Although Gould escaped much of the financial damage by quietly selling portions of his holdings beforehand, countless speculators were ruined. James Fisk managed to avoid complete financial collapse through legal maneuvering and contractual disputes. Ordinary investors proved far less fortunate. The event became known as Black Friday, not because the economy permanently collapsed, but because confidence disappeared almost instantly. The immediate financial panic gradually subsided, but its effects lingered. The scandal damaged public trust in financial markets. Questions emerged about political influence, corruption, and insider information. Congress launched investigations. Although Gould and Fisk avoided severe criminal punishment, their reputations became permanently associated with one of America's greatest speculative schemes. The episode also demonstrated an important economic principle. Markets relying heavily on leverage and speculation become extraordinarily fragile. When confidence reverses, prices often fall much faster than they rise. Government credibility became equally important. The Treasury's intervention reminded investors that public institutions could still influence markets, despite private attempts at manipulation. The gold panic of 1869 feels surprisingly modern. Replace gold with technology stocks, housing, cryptocurrencies, or commodities. The underlying mechanics remain remarkably similar. A scarce asset attracts investors. Prices rise. Speculation accelerates. Borrowing increases. Confidence becomes self-reinforcing. Eventually, reality interrupts the cycle. Markets correct. Those who entered late often suffer the greatest losses. The episode also highlights the importance of transparent regulation and independent institutions. Without confidence that markets operate fairly, investment declines and economic growth slows. Perhaps most importantly, the gold panic demonstrated that no individual, regardless of wealth or political influence, could permanently overpower the financial resources of the United States government. The Panic of 1869 wasn't merely a failed attempt to corner the gold market. It was a defining moment in American financial history. Jay Gould and James Fisk nearly manipulated one of the nation's most important markets, exposing dangerous weaknesses in politics, finance, and regulation. Their scheme collapsed in a single day, but its lessons have endured for more than 150 years. Because markets may evolve, technologies may change, and assets may differ. Yet speculation, greed, leverage, and the belief that prices can only rise remain remarkably constant throughout history.